Everybody wants to know if the housing market is going to crash. Interest rates just went up over a point in less than 30 days. Look, ladies and gentlemen, there is a lot happening in the housing market right now. Are we on the brinks of a foreclosure nightmare or are we not? Hi, everybody. My name is Jerome Maldonado. I've been investing and developing real estate for over 25 plus years, and I'll tell you that this month we are seeing changes in the market that we have not seen in quite some time. So I want to go over with you guys a little bit of information. I just did a video on the foreclosure crisis that we may be embarking on or may not be embarking on a prior video that you guys may have seen just a couple weeks ago. Now, I want to bring you guys some new national data that was released on what's happened over the month of January in our current market sector. And so just to give you guys an idea of what the rising interest rates are going to do to our market, because I know, one thing that I know is that people are concerned. They're sitting back and they see this hyperinflation of goods and services all over the country. They're seeing a mass appreciation of houses, and they want to know, how does this affect me? Houses have appreciated over 15% in 2021, which is more than double what they appreciated in 2022. A mere increase from over just 6% increase in 2022 to over 15%. So that's a big separation compared to 2022. And single family homes are increasing in price by over 18.5% versus November, their increase of only 18.1%. So we're seeing a ton of movement in the market right now, and a lot of it has to do with housing appreciation and rising housing values themselves. And so when CoreLogics went out and interviewed clients, and they said, look, home buyers, are you concerned about buying a home right now? Only a quarter of who they interviewed said they felt good about buying a home right now. And 69% of them said, I feel better about selling a home right now than I do buying a home right now. And so, you know, when we take a look at the numbers and we're looking at this growth, I know that it's real easy to sit back and say, okay, these are very similar trends to what we saw to what we saw in 2008. As we go through this video, you're going to find out a lot more about the differences that we go over on where we are today and where we were in 2008. So if you're sitting back, you're waiting to buy, hoping the price levels may drop, you may want to think again. Because in spite of rising interest rates, the market is healthy. Right now, when you go back and you talk to industry professionals, like Mr. Kelman, the Redfin CEO, one thing that he talks about and they feel comfortable about when you're talking to the CEO of Zillow and Redfin and some of the large industry leaders is that they're very confident in the strength in the market. So when you ask these industry leaders, what is it that you see being the biggest factor in the market right now, they say, well, rising interest rates. And so people are concerned. And one of the big concerns is that these rising interest rates that we see today is similar to what happened in 2006 when we saw rising interest rates. And all of a sudden, there was a buying frenzy. People were afraid that interest rates were going to rise. There was a buying frenzy, and the Federal Reserve had lowered the qualifications to the average single family home buyer. So people with D credit, 650 credit scores at that point in time, were getting home loans. And I'll tell you that it was concerning and alarming. That's why the CFPB was put together in 2009, because it's the Consumer Protection Bureau. And what their job is to make sure that not only the consumers, but the banks are abiding by guidelines and laws to be able to make sure that our economics never go back to 2008. Now, has the CFPB done their job is the question, right? So let's take a look at some of these numbers. And before we do, if you guys like the content that we're providing, click and subscribe to our YouTube channel, pound that thumbs up button, and to get notified for more content just like this. Now look, when we take a look at rates went up by over 1 point just in the last 30 days. Now, our current 30-year fixed mortgages are currently at 3.87%, which, if I go back and I reference some of the concerns in the market, one thing that the Redfin CEO, Mr. Kelman, said, he said, look, I think that once we rise interest rates over 3.5%, we're going to start seeing some stabilization in the market, but there's a huge inventory crisis. And so we have reached that level at this point with a 30-year fixed rate at over 3.87%. So what does that mean for home buyers? Well, I'll tell you, from the beginning of the year, that's over 50 basis points higher than we were in December of 2021. So rates will continue to go up as the Federal Reserve holds back purchases and holdings of mortgage-backed bonds. And so as they hold back on mortgage-backed bonds, we're going to continue to see interest rates rise. Now, what will they rise to? Last year, I predicted that they would be at 5% by the end of 2021. Graciously enough, they're not there, and so the housing market has continued to stay stable. And as long as interest rates stay low, in spite of them being at 3.87%, it's still at historical lows right now. So when you take a look at the stability of the market, and we look at interest rates, in spite of them raising by 1 point, we're still sitting in historically low rates, and we have a significantly low inventory rate. And so as long as the inventory rate for housing is as low as it is, we're going to continue to see buyers buy at increased prices. We may not see the double-digit inclines that you've seen in the past, where we're seeing 14% growth patterns year over year, 18% growth patterns year over year. I think we're going to get back down into the single digits. I still believe that 2022 is still going to be a double-digit year. I believe that home prices will increase and inflate over 10% this year, whereabouts. I think they're going to hover right around that single to double-digit trademark between 9 and 10%. But I think that we will see the housing prices start to stabilize a little bit. I don't foresee that we're going to start seeing them stabilize tremendously, but I do think that we'll start seeing them stabilize a little bit. Now, when you sit back and you look at the market and you're an investor and you're looking at this and you're sitting back going, okay, how does this affect me as an investor? How does this affect me as I move forward in the market? Do I need to be concerned about these rising interest rates? Do I need to be concerned about the type of investments that I'm buying? So the answer to that is yes, you do. So when you look at your buying numbers and you're an investor, let's take multifamily as one of those things that's very, very attractive. And I'm going to talk about the single family market sector as well as we move forward through this. But let's take a look at the multifamily sector. Since multifamily has been so hot for so many years, if you're a real estate investor and you're looking at buying multifamily real estate, 4plexes, 8plexes, 50plexes, 100-unit builds, a lot of the large acquisitions now are selling for sub 4% cap rates. So 3.5% cap rates is what's going on nationwide in most purchases. So as we raise at 3.87%, that's an issue. Because if you can't get a loan for less than 3.5%, you're going to be servicing interest debt to the bank if you're purchasing assets at a 3.5% cap rate. So how does this work? You sit back and typically it's an 80% loan to value on purchasing commercial assets, being 20% minimum down payment for a commercial asset. So if you come in and you pay 80% on any asset, just take a $1 million asset. They give you a loan for $800,000. You put down a down payment of $200,000. Now, if your interest rate is 3.5%, you do $800,000 times 3.5%, that's $28,000 per year in interest. Now, you take $800,000 times 3.87%, which is a 30-year loan, right? Typically these loans are 20-year loans. And so if you get a loan at 3.875%, that's $30,960. That means that you're going to have to fund $2,960 every year out of your pocket just to service the 80% portion that the bank has lent you, just to service the debt on the over the 3.5% cap rate that you purchased that asset at. So how many investors do you know that want to purchase real estate at a negative earning? Well, my hand goes down to that one. I don't want to purchase real estate at a negative earning. I don't want to come in and have to be servicing debt. What I call that trash can money. So when we start seeing interest rates rise above cap rates, we also know that we have to caution ourselves in commercial purchasing. So with increased interest rates, we're also going to slowly start to see an increase in cap rates. There is no way that any bank, financial institution is going to lend buyers money for assets that are being purchased for less than the interest they're paying on any asset. So understand that as we start seeing this market change, as we start seeing this market change with interest rates, we're going to start seeing cap rates on investment properties change as well. So for those of you who have gotten excited about seeing these low cap rates when you're selling properties, some of you buyers might want to caution yourself in purchasing just immediately on Class A assets or even value add assets in the Class C market sector, because as we start seeing inflation of interest rates, we're going to start seeing cap rates start to rise as well, which means that we'll start seeing more of a stabilization in the commercial sector. Now, what does this do for residential buyers? Well, I'll tell you, slightly different than the commercial buyers. Since residential real estate does not sell based on cap rates specifically, we start seeing a different trade-off. Now, one of our business models is to buy land and build houses, and also buy land and build apartment complexes. People ask me, Jerome, with hyperinflation and materials and goods being so expensive, why would you build assets? Aren't you scared of building these assets with such high build costs? And my answer to them is always, not necessarily, and here's why. Now, there's always a threshold of reasonability with any aspect of any asset class that you have to caution yourself with and be able to go in conservatively and build. But when you go out and if you build under a specific business model where you're doing a cost plus model, like for sake of example, you do the cost of labor plus materials, a lot of contractors nationwide will build at a 15% cost plus model. If you go out and you do a bid model and you have a contractor just bid it for you, because what's happening in the market out there, we're seeing such mass appreciation of assets, and we're seeing such an inflation of goods, they're going to bid that project extremely high. Hence, it may land up setting you in the exact same position that we're seeing with commercial purchasing. And so if you go out and get a Class A builder to build you a Class A product and you get the big guys, you may be at a 3.5% cap rate at the end of construction, which hence is a bad place to be with interest rates rising. So we choose a cost plus model. Why do we choose that model? Because we can manage paper. We can manage subcontractors. We can manage the cost of materials and amenities that go into any build. So when you look at housing, single family or multifamily developments, when we function on a cost plus model, we can come in and we can control our overall expenses and costs throughout the course of the build. Now, what does this do for us? When we go in and we build these, for sake of example, we can come in and we typically can build out an asset with a cost plus model at about a 30 to 40% equity stake in the property, which means that once we actually stabilize that property, we walk into it with between 30 to 40% equity, which means our loan to value ratio is only 60 to 70% loan to value. And so when we do this, we are at about a 10% cap rate. Now, if you reverse engineer the cap rate to fit the rising interest rates for investors, this works out extremely well. Follow me here. If you go in and you can stabilize an asset, new construction at a 10% cap rate, or even as low as an 8% cap rate, as long as interest rates don't exceed 8% or 10%, which it's very low likelihood that they would, because that would demolish the market sector, right? So if interest rates even raise to 5% and you go back in and you refinance that asset at an 80% loan to value, and let's call it a 6 cap or a 5.5 cap even. We'll do a 5.5% cap rate. And if interest rates are at 3.5%, you can go back in and you can get with your lender and say, I want to be able to leverage this asset to 80% loan to value, and I just want to pull out the other 20, the excess equity in this property to utilize it to continue to invest in other properties. What's good about that is the equity that you pull out of that asset is tax-free money because it's a loan. It's equity that you've built into that asset that is not profit, because you haven't sold the asset. As long as you don't sell the asset, you don't have the tax liability. If you sell the asset, you have to capture those gains on the sell. But if you keep the asset, you don't have to capture those gains. It's a loan. You take that money, you can reinvest it into other stuff. Not only that, you can depreciate the asset and you have extreme tax write-offs. Now, ladies and gentlemen, you can go back in and put yourself in a good position where you're at a 5.5% cap rate. You have 80% loan to value. You pick and choose based on the 5.5% cap rate. You're at an 80% loan to value, and you can pick and choose what type of cap rate you want because you have some volatility in your cap rate, being that you have so much equity in the asset. Substantially more financially viable and less risky than going out and buying Class C and Class B and Class A assets right now, with cap rates being so low and the volatility in interest rates. Not foreseeing the future, I always encourage investors to exercise their investments with caution. I know what you're thinking. You're sitting back saying, okay, Jerome, but how much longer can we see this? And so we take a look at prime markets. We take a look at Florida being this is like the pinnacle state, right? Florida's like the pinnacle state of real estate. What happens in prime markets is the rest of the nation typically follows within a 2-year sector. So what was happening, if you look back at 2006, Miami hit an all-time high in 2006. And then in 2008, the rest of the nation started to see that exact same peak in late 2007, early 2008, right before we dipped into the recession of 2007, 2008. So we take a look at these numbers, and when you see it in 2006, we see a huge peak in the market and then a huge decline in the market. Now, we've seen just a steady, healthy growth. And one of the big things that's happening right now when you talk to banking institutions like Merrill Lynch, Goldman Sachs, and all the big guys, is that you sit back and you talk to them and they say, you know what, banking today is healthier than it's ever been and substantially healthier than any time in history, especially 2008. The question is why? How could that be? Well, they have more credit-worthy purchasers that are more affluent, and they have higher credit ratings and higher and stronger buyers. So we have a healthier, stronger banking system now than we had in 2008. So if you're sitting back and you're comparing what's happening now to 2008, as I talk about this, you may want to reconsider, being that banks right now are sitting at a more stable and more affluent place than they ever have. Look at Florida as an origin state, and you take a look at what's happening nationwide, typically the rest of the country follows suit within a 2-year period. And so if we take a look at the healthy growth that's happening right now in Tampa to Miami, residential-wise, you can depend on some of the stats that come out of Miami and Tampa as what's going to kind of happen historically over the course of the next 2 years nationwide. Now, you sit back and you say, okay, Jerome, how much longer can this happen? How much longer can this continue? Are we going to start seeing, as interest rates rise, are we going to see a falling market? And we're going to start seeing stabilization. So if you take a look at what's happened over the last few years, and if you even go back historically into the 1970s, 1980s, and 1990s, one thing that you'll find out is that we, as builders, go out and build about 10 million homes every decade. Okay, 10 million homes every decade. And so if you look at it historically, what happened is that we built about 12 million homes from 2000 to 2009. 2008, the recession hits, and every builder, everybody in the real estate sector gets scared of anything that's happening that has to do with construction and real estate. So from 2010 to 2019, we only built out 6 million homes. So for those of you guys that are sitting back right now thinking, how in the world did we allow ourselves to have such a housing crisis? This is a rollover of residual from what happened in 2008. And so the scarcity mindset for builders and industry professionals was that they just cut back production to be able to stabilize their finances and continue a more healthy growth at a smaller and shorter pace. Now, understand that when this happened, we still had an influx of births in America, right? We have all of the baby boomers are getting older and retiring. Then we have the Gen X, which is larger than the baby boomer population. Then we have the millennials, which is substantially larger than the Gen X and the baby boomers. Now we have the Gen Z population. The Gen X population is all in their 40s and 50s. The millennials now are all in their 30s, in late 20s, and now we have the Gen Z population coming up in high school years and as teenagers moving into adulthood. And ladies and gentlemen, we are short over 5 million homes. And so when you take a look at things, back in 2019, we had only 2 million homes on the market, which was an issue at that point in time, because it takes about 5 million homes on the market, according to the National Association of Realtors, just to have an even market sector, so that it's not a buyer's market or a seller's market. It's just an even playing field. And in 2019, we had 2 million homes on the market. Currently, we have just slightly over 1 million homes on the market today. So what that means for you as an investor, for you coming into the market sector and say, hey, I want to fix and flip, or I want to buy rental homes, or I want to just buy single family homes as an investment for myself, there's no better time than now to purchase a home in the single family market sector, being that there is such a shortage. I believe that we're going to continue to start seeing inflation in housing and appreciation in the housing market. I think it will stabilize as interest rates rise. I think that we'll have a really short and compressed real estate market this year, where typically we see the housing market boom for 3 to 4 months. I think we'll see that compressed down to maybe 2 months, maybe 3 months. But I think the housing boom will just be slightly shorter this year, but market prices will start to stabilize. That just means for buyers that as interest rates go up, the amount of home they can buy is going to be substantially less. But the housing market will continue to see appreciation. So if you're waiting for a better price, I think you better stop waiting. And if you want to buy a house, the time is now. As an investor, an end user, or whatever market sector that you're in, it's still a good time to buy a home based on statistical numbers. This doesn't mean that just because interest rates are rising slowly and there's still going to be a need for housing, that you just go out there and buy anything. You don't just go out and buy absolutely anything that's on the market or build anything out there. With this, that's why I want to explain to you guys our business model. So ladies and gentlemen, what we do is we buy land, we build houses, and we build a specific sector. We're not hitting the mean, the average, the $350,000 homes. And the reason why is because typically, if you look historically at the houses that go into foreclosure in mass quantity, it's the mean, right? It's the mass majority of people. It's the 60% of people that live in that sector of $350,000 homes that is our new mean post-pandemic. And so we don't build in that sector. And we also don't build in the multi-million-dollar sector, because the multi-million-dollar sector, the ultra-wealthy don't get affected by it. But the people, they over-leverage themselves. The people competing with the Joneses, the people that want to go out there and have that extra luxury but are living middle-class, have middle-class wages or upper-middle-class wages, when things get compressed, that's the secondary market that gets hit in times of economic distress. That secondary home market, the beach condos, the ski condos, the secondary housing market gets hit second. Now, the market sector that we hit is the stabilized income earners in America, the upper middle class and just above the mean. So those people that are in that $450,000 range up to that $750,000 range are the people that we hit in the single family housing market. Why? Because those are our moms and dads. Those are our grandmas and grandpas. Those are the people that are in the upper Gen X population that have worked the last 15, 20, 25, 30 years and have a savings. They have a nest egg of capital. They have equity in their homes. They have stability in their lives. And volatility in the market doesn't typically affect that sector of buyers as much as the new home buyers, the people in the mean, the people that are going in and can barely qualify for the average home. So when we build in that market class, that market sector, to protect our investment. Second thing that we're doing is we're building new apartment complexes. We're not going out and building Class A apartment complexes. We're not going out there and competing with all of the beautiful clubhouses, the swimming pools, the gyms, and all the amenities that come along with Class A building in the apartment sector. What we do is we go, let's take Class A assets, Let's simplify them. Do a 3-story build. Let's keep them super simple. No elevators, not major amenities, maybe a small gym. Get rid of the pools, but we have a brand new apartment that fits the exact same type of construction as the Class A asset without the amenities. So we don't have all of the management and maintenance fees that typically go into managing a Class A asset, where you're spending 40 to 45% of your gross income potential or gross operating income on managing the amenities. We can manage our properties at 25% or even 30%. But we're able to give Class B rents to a Class A asset and compete with Class B assets, which would most people want to live in, old or new. Most people would take the new over the Class C, Class B asset because it's new construction. So the people that are living in the Class A multifamily, they're not going to go to Class C living. They would much rather go from Class A living to another Class A asset with less amenities, but still have the new feel of a brand new build, instead of stepping down into something that's more vintage. And so when we go out and we can compete with Class B rents but have a Class A asset, it puts us in the commercial sector where it makes more sense to build that, and it's more recession proof. Now, ladies and gentlemen, that doesn't mean that I'm telling you that we're going into a recession. Doesn't mean that I'm telling you that the market's falling apart. We're just exercising our purchases and our builds with caution, setting ourselves up, thinking about the worst, but setting ourselves up for the best. Now, ladies and gentlemen, if you want to hear more content like this and you want to hear my take on the housing market and learn more about what we do, click below and watch this housing video that I produced 2 weeks ago to find out a little bit more information and a little bit more detail on information just like this. Click either to the sides down below or up above. We'll put in the link, and I look forward to seeing you on the other side next time.